I'm going to continue introducing a few more different trading strategies. And if you remember, or if you want to go back and look at some of the others, we're bringing these into play because markets change, the market dynamics change. And, as ever, we should always adapt to anything that changes, not just in trading, but, as things that go on in our life. And, one of the key things is to trade slightly differently as we adapt to changing markets. And it's hopefully that way that we become less one-dimensional and we can actually glean best rewards out of changing markets and market structures. So one of the key things around range trading, in effect, is a pretty simple strategy. And really all we're looking to do is buy within a range, as it says. But what are the benefits that we can get from adopting this style of trading? Well, one of the key things is that we should start looking at range trading when volatility starts to come out of the market. How can we see volatility come out of the market? Well, I think as individuals, we will feel momentum maybe gets lost. Maybe we look at the calendar and there's very, very little on the calendar. Maybe we feel market positioning is fairly flat. And we could even look at some of the technical analysis and look at Bollinger Bands and see maybe the envelope start contracting as well, which again is generally a signal of low volatility. But one of the other key things is because of the nature of this trade strategy is we can actually add leverage to this trade. So we can actually try and take bigger positions because there is a clearly defined stop loss within this trading style that allows us to put maybe a bit more leverage on. And although markets are not moving as far, we will have a little bit more leverage in those markets. Now, there are a few key considerations for trading this strategy. The first one is that we actually have to define these ranges ourselves. Generally, we're not going to get inside information or somebody saying these markets are all going to move into ranges. Where we're constantly looking at our charts, I think we'll get the feeling that these ranges may be beginning to persist. We start looking at our charts, and as we see here in the Germany 40, just from recent days, I maybe looked at this and felt we had a decent support level down there at 15,885 on June the 1st, and we rallied up to a high on June the 5th of 16,134. With all other conditions in play for me, maybe that was a range that I felt I could actually play. And so that's the first part of this. We are actually going to find this range ourselves. We find the significant high, we find the significant low, and off we go. This is where we start trading this structure. The key thing, and this is where the leverage comes in, is that we have to understand what we're trying to achieve here. We have made the decision that markets are going to start moving a bit sideways, and therefore volatility comes out the market. Once we break either of these two sides, the support and the resistance, or the resistance, this whole strategy disappears because maybe some volatility has come into the market to start pushing us outside these bands. And at that point, we have to say, gone, no more range trading. And therefore, we need tight stop loss protection below the support line and above the resistance line, because all bets are off once we start moving outside of these ranges. And purely the fact that these stop losses are tight, I mean, you see I put 50 points on here on both sides. That's not science. That's just a number I've put on it. It will change by product, and you will understand where you feel that should be, that level of slippage to stop us getting involved in any false breaks. You'll get that with experience. So it's not something I can just tell you a number and you just apply it. It's something that comes with experience. But the important thing is it's pretty tight. And because it's tight, you can actually add a little bit more leverage to your position, because you're generally going to be buying as close to the support line or selling as close to the resistance line. And that is your entry or exit point. And therefore, your stop loss level is pretty tight to that, and therefore, even with a bit of added leverage, it's probably still affordable. Now, some people will say, why am I going to trade these ranges? They're boring. Well, you sometimes do have to have patience. But even on this chart here, there's a range of 1.5%. Now, if we played this nicely and it persisted, even for us to trade it 1, 2, 3 times, I'll take 1.5% in a low volatility environment with a little bit more leverage any day. So again, it's us adapting to fresh market conditions. The key to this strategy, as I mentioned, is the discipline of your stop losses. Do not move those stop losses as it starts to break, because then you're going completely against the rationale for this style of trading. A couple of things that you really should understand. Characteristics of these ranges is that even though we have defined here the June 1st low and the June 5th high, as volatility continues to come out of the market, you may find that these ranges actually contract. And as you see here, we've moved in more closer to the blue lines. But also you might see some market bias come in. The sellers have most definitely moved their offers back in a lot more aggressively than the buyers. So we're actually beginning to see some bias here. And that could well be because this chart has come up, been on an uptrend, and as volatility comes out of the market, maybe the sellers are getting a bit more anxious and they're trying to bring their offers in lower to square up their positions. So there is always some rationale behind why these ranges may actually contract and certainly show some bias. Another key thing that we should understand as part of the strategy is sometimes our orders may not always get filled. And I'll show that as we play out a bit of a trading strategy here. The key also is that we adapt our order management as and when we feel that these parameters may be changing, as in further contraction or maybe some topside or downside bias. The one thing we do always have to be wary of as well is that volatility kills this trading strategy. So we must always be looking ahead. If there is something on the calendar that could introduce a volatility spike, we have to start making some decisions. Either we stop playing this range, or just before we feel there's an event that's going to introduce volatility, we just square up. But we have to be cognizant of it. There's no point being caught out. And in this instance, as tonight we have a Fed release and tomorrow we have ECB interest rate releases, we know inflation is hugely important as a market driver at the moment. So any information that comes fresh from these meetings is going to impact these markets that have contracted. They'll probably introduce volatility. So that in itself could be the trigger for us to stop playing this range. But let's say this range had been playing like this for 2 weeks. I would be happy continuing playing that range until we anticipate a volatility spike. And then I just walk away from this trading range, and then maybe I start looking at more directional moves as volatility comes in. Now, very quickly, as I'm going to play out a couple of little trades on this chart, one little tip from me, and this is not textbook stuff, it's just the way I look from a psychology perspective, is you will generally always have a view and a feel on the market. And I would always err on the side of your first entry trade, where you take your first open risk in a trade ranging strategy, should be along the way of your overall view of the market. As I said, this market has come up before it started going sideways here. So I probably would still want to err on the long side as my first open position. So I'm looking to buy as close to that black line, which is my defined support level. That's where I get my first entry level. Clearly, the simplicity of this is that I now want to sell as close to my upside limit, the resistance line up there at 16,134, and that's where I would put my resting sell order. Now, as we see here, the market contracts a bit quicker than I would have thought, but I had to bring you a fairly live example, and there is rationale as to why this has happened, which I'll go into very briefly in a minute. But our sell limit order doesn't get touched, and the market clearly does start contracting. if I'm ever aware of what's going on and I understand some of these characteristics, as the market hits that blue line the first time and comes down nearly to the low, I'm still long, remember, for my first tranche on the left-hand side. If I'm thinking on my feet, I now may be feeling that the new top is that blue line. So as we bounce, my new strategy is to try and sell out my existing long position somewhere close to that blue line. If I achieve that, I've actually played a range. Now, I haven't captured that 1.5%, but maybe I've captured 0.8, 1% or whatever. I've traded the range. Now what happens, I have the patience to wait for the market potentially to come back down to that low, which it does. That gives me confirmation that my lines are good, my support is good. I managed to buy some close to that low, and it's eat, sleep, repeat. We get up towards previous highs, I'm selling out again. I then try and put a buy limit order in, but we don't achieve it. Let's not get disappointed by that. Let's start thinking, is that giving me new information? Is the market contracting again? So I'm ever adapting to potential contractions. But again, I'm always trying to continue with the theme of where I think the market may be going as my first tranche of order. So I'm buying and then selling, reinstating my long, selling again. And then as the market keeps telling me new information, I can play it accordingly. Now, in this instance, if I'd have been confident, a bit more confident, having played it twice, if we jump up and we get up to that resistance line, then maybe I'm confident enough to instigate a sell order as my first short. So I'm openly short up there. Why can I do that? Well, because again, I'd have a very, very tight stop loss, and so it's still affordable for me. I may feel a bit more uncomfortable buying short in a market that eventually I feel will go up, but remember, I'm still trading the range. I still feel volatility is low, and I'm just practicing the characteristics of range trading. One other key thing, if we do start playing contracted ranges, remember you are actually moving your entry levels a bit further away from your stop loss. Your stop losses should always be outside of your original range because we know they're defined lines. So as they become a bit more expensive, the key here is to reduce the amount of risk to make those stop losses affordable, not move the stop losses closer to my market entry. That's very, very important. As ever, I should be looking forward, and the reason why this market was contracting was because we have these big sets of data coming out, and that's the Fed tonight and the ECB tomorrow. What would I be looking at? Would I instigate that third entry level, that sell order at the top so close to this big announcement? Probably not. I would enjoy the fact that I'd played some of that range twice. I maybe have taken 1.5% out of the market. The strategy has worked, but I probably have to put that in the locker because I've potentially got a volatility spike coming at me. So hopefully that helps. Hopefully it showcases how we can adapt our trading style to different markets, but we always have to stay alert. And the key thing is understanding the characteristics of those markets that you're trading slightly differently.